Welcome back. In this session, I'd like to continue our discussion of regressions. Let's start with a very simple question. When you're going to run a regression, we know there's always a dependent variable and always independent variables, sometimes one in a simple regression and sometimes many. The question is, how do you come up with these dependent and independent variables? Let's start with the easy half of that. The dependent variable is whatever you're trying to explain. Differences in PE ratios across companies, changes in interest rates over time. The independent variables, though, there are two ways you can come up with a list of independent variables. The first is pure statistics. You collect data on multiple variables, and then you look statistically at which variable seems to have the strongest relationship with your dependent variable. The statistics drive your choice of independent variables. In fact, there's a process called stepwise regression, where statistically the program you use will pick the variables that have the highest correlation, then the next highest, and move down the ranks. It almost automates the process. The problem with statistically finding independent variables, and we're going to come back and talk more about this, is it opens the door to data mining, finding variables that give you a high R-squared but have no economic rationale or common sense behind them. So my suggestion is, at least in investing in finance, if you're going to build a regression, those independent variables have to start with common sense, intuition, and economic model, which would lead you to make predictions, and then the independent variables can be used to see if your predictions hold true. Again, that sounds very abstract, so let's take an example. Let's assume you're trying to explain differences in PE ratios across companies. You're saying, well, what do I need to control for? Well, here's one way you can approach the problem. You can say, in a world where people cared about value, what would drive the PE ratio for a stock? I'm going to start with the simplest discounted cash flow model I know of. And if this looks foreign to you, don't worry, we'll get to it in more detail later in one of the investing classes. It's called the Gordon growth model. In the Gordon growth model, the value of a stock is a function of the expected dividends next year divided by the difference between the cost of equity, which reflects the risk of the stock, and the growth rate in that stock. It's called the Gordon growth model. It's a stable growth dividend discount model. You're saying, how is this going to help me deal with PE ratios? Let's assume I divide both sides of that equation by the earnings per share. I'm allowed to do that, right? I divide an equation by a constant on both sides. It still remains an equation. Dividing the price by the earnings per share gives me PE ratio. Dividing the dividends by the earnings per share gives me what's called payout ratio, the percentage of my earnings that I pay out in dividends. I now have an equation for the PE ratio, at least in this model, for a mature dividend paying company. And guess what? The PE ratio is a function of three variables. The payout ratio, the percentage of earnings the company pays out in dividends, its expected growth rate, and its cost of equity or risk. In fact, I can go further. Looking at that equation, it looks like companies with higher payout ratios holding growth and the discount rate constant will have a higher PE. Higher payout ratio should lead to higher PE. Companies with higher growth rate holding all else constant should have higher PE ratios. And finally, companies that are riskier, which should have higher discount rates, should have a lower PE ratio. That very simple equation gives us those dynamics. So let's say I want to use this to build a multiple regression to explain PE ratios across all US stocks. Before I run the regression, I want to check to see whether I'm going to be dealing with a variable that is linear or non-linear. So I start, as I always do, with scatter plots. Here I've taken price earnings ratio, which is what I'm trying to explain, against the expected growth rate in earnings. Why? Because the conventional wisdom is higher growth companies have higher PE ratios. When I did the scatter plot, I got some good news and I got some bad news. What's the good news? Higher growth companies do tend to have higher PE ratios. See this line? It's a best fit line. It is upward sloping. You're saying, what's the bad news? There's a lot of noise in this regression. You know what I should be ready for when I run this regression? Given that there's so much noise around the line, I should expect to see that my regression should have a relatively low R-squared. So I decided to run the regression of PE ratios against three variables. And as I list the three, you're going to see why I picked these three. The payout ratio, because it captures what I think should be in the regression. the beta is a proxy for risk, and the growth rate is a proxy for growth. You're saying, what do you mean proxy for growth? Remember, there are lots of different ways I can forecast future growth. I can look at past growth, historical growth. I can get expected growth in earnings per share for the next 5 years from analysts, which is what I've used. I can look at growth in revenues. For risk, I can look at how big the company is, how variable its earnings is. I've used beta. I've chosen to use these proxies. We'll come back and talk about what if these proxies don't work well. In this regression, I've looked at PE ratios as a function of these three independent variables. So let's break the regression apart. First, the R squared is about 40%. Am I disappointed? When you run a regression, it's not a question of whether it's what the data tells you is true, is true at least among these companies. These three variables that in theory should explain difference in PE ratios across companies explain only 40%. I have to take what I can take. Now, when you look at the coefficients on the regression, here's what I start with. I start with an intercept of 4.10. That's a base from which I'm going to build off PE ratios. As my payout ratio increases, my PE ratio goes up. And I can tell you by how much. The coefficient measures by how much. As my beta goes up, my PE ratio goes up. Riskier companies have higher PE ratios. You're saying, but wait, the theory said that riskier companies should have lower PE ratios? Hey, the theory can say whatever it wants. The data says that's not true. We're going to see why that happens in a couple of pages. But a higher risk stock seems to have a higher PE ratio. And finally, companies with higher growth have higher PE ratios. I just stopped with those three, but those three come from the model from which I'm drawing the variables. This is not a kitchen sink regression. You know what kitchen sink regression is? In a kitchen sink regression, the end game is to get a higher R squared. That's not my end game here. The end game here is to use variables that I think should matter to try to explain difference in PE ratios. Now, before I use this regression though, I need to check these coefficients to make sure that statistically they're actually different from zero. The way you measure that is either with the t-statistic or the p-value. And you can see payout ratios and growth clearly pass the test. They're statistically significant, but beta doesn't. Now, when you have a variable that does not have statistical significance, you know what you should do? Take it out. The fact that it matters in theory is irrelevant. It is just adding noise to the regression. Taking payout ratios, in this case beta, out of this regression reduces my R squared, but just by a tiny bit. In fact, what I'm left with, the two coefficients, are actually statistically significant. Leaving low t-statistic variables in a regression just adds noise to your prediction. So let's go further with this regression. Remember, one of the things we said with multiple regressions is that the independent variables are supposed to be independent of each other. So let's actually see how close we are to meeting that assumption. This is payout, growth, and beta. And if we were running a perfect regression with uncorrelated variables, then all of these numbers off the diagonal for payout, beta, and growth should be zero. In other words, beta, growth, and payout should be uncorrelated with each other. There's zero chance that that's going to happen because companies with high payout tend to have low growth and low risk. So the three variables move together. And you're seeing that reflected in the correlation coefficients. You're saying, what are these stars? That means those numbers are statistically different from zero. Growth and payout are negatively correlated and it's statistically significant. Growth and beta are negatively correlated and it's statistically significant. That's multicollinearity. Now, taking out beta, therefore, is a good thing because I'm taking out one of the variables. The other two still have multicollinearity. I could try to find other proxies for payout and growth, but my guess is no matter how hard I try, multicollinearity is going to be something I can't get rid of in this regression. So you know what I'm going to do? I'm going to live with it. Because remember, even with multicollinearity, I can make predictions using this regression. But let's say you get focused in on improving your R squared. What can you do? One is, as I said, you can look for better proxies for payout, growth, and risk. The proxies I use, the growth in earnings per share for the next 5 years, the 2-year regression beta, and the payout ratio from the most recent year, you might feel don't reflect, are not the best predictors for the future. So you can look for better proxies. Maybe you can add other independent variables with a caveat, which is if you're going to add another independent variable, have a good reason, a story, a common sense rationale for why you think it belongs. So your story might be that companies consistently underprice companies, or markets consistently underprice companies with lots of intangible assets, tech companies. So you know what you could do? You could look at a variable that measures whether a company is in the tech sector or not and throw that into the regression. Maybe that'll improve your R-squared. But don't throw in variables just because they improve the R-squared. Have a good reason for including it. You can also check for outliers. Outliers can work in both ways. Sometimes they can push up your R-squared if the outlier is cut in the right direction, or they can push down your R-squared. So if you have a stock with a PE ratio of 10,000% and a growth rate of 150%, it can make your R-squared look much higher than it should be. Conversely, if you have a company with a PE ratio of 10,000 and a growth rate of minus 15%, it can push your R-squared in the other direction, even with large samples. There are two things you can do with these outliers. One is you can cap the number that's an outlier. In this case, a PE ratio of 10,000 is unusually high. You can say, well, if a number exceeds 500 for the PE ratio, I'm going to put 500. The other is to remove that observation from the sample, something you should do very reluctantly, because once you get started with removing outliers, where do you stop? In some cases, you can improve the R-squared by going from an ordinary least squared regression to a weighted least squared regression. Let me tell you when that might happen. The regression that I ran initially was across all US companies, with each company weighted the same, large as well as small. The R-squared I got was only 15%. I noticed that larger companies were better behaved in terms of PEs being related to growth and risk and payout, larger in terms of market cap. So the regression I ran was a weighted least squared regression where I weighted companies based on their market cap. Bigger companies were weighted more than smaller companies. So that's a process of building a regression. You can see it's a mix of common sense and looking at the data and making judgment calls. And your judgment calls can be different from mine. Before I leave this section, I want to point to some things that happen in practice, even in academic research and supposedly scientific research. Our access to data improves and we get more and more data and more variables. We're getting more exposed to what's called data mining. What does that mean? You start looking for variables that give you higher R-squareds, higher T-statistics. And if you look long enough and hard enough, you'll be able to find that. So one of the problems we've been facing, especially over the last 10 or 15 years, is as the data in finance expands, it looks like there are more and more things we can use to explain stock prices. You're saying, what's wrong with that? None of these actually work in forecasting prices, but they do a good job of explaining past prices. That's data mining. Sometimes in the hands of researchers, you get what's called p-hacking. What's p-hacking? Remember, the p-value tells you whether a coefficient is statistically different from zero. And basically, you want the p-values to be really low numbers, the t-statistics to be really high numbers. Now, if I'm a researcher with an agenda or bias, I can play games. Play games in what sense? Look at time periods that give me better t-statistics and lower p-values. Remove companies in my sample that make my t. You're saying that's unethical. I agree. But that doesn't mean people don't do it. So when you see a regression output, one of the questions worth asking is, what is the bias of the research and how will it show up in the numbers? And finally, there's a principle in statistics and investing that we need to keep in mind. Something can have statistical significance, but that doesn't mean it has economic significance. I'll give you an example of where this works. I can build a regression model that predicts what the market will do tomorrow based on what it did today. In other words, I can run a regression of tomorrow's returns against today's returns, perhaps find statistical significance. You're saying this is good? Then you try to buy based on that model or sell based on that model. At the end of 300 days, you look at what you made, you're saying, what happened? Trading costs money, there are frictions in the marketplace. You're not catching that in your t-statistics. So sometimes, just because you get statistical significance doesn't mean you can make money off what you find statistical significance in. Let's take a second phenomenon you could run into. Remember the regression of price earnings against growth? I started with a scatter plot and it looked pretty linear to me, so I ran a linear regression. There's another pricing multiple called the PEG ratio. You're saying, what's a PEG ratio? It's a PE ratio divided by the growth rate. So if I have a company with a PE ratio of 20, with a growth rate of 10%, 20 divided by 10 is 2. Its PEG ratio is 2. You obviously want to invest in companies with lower PEG ratios. You're paying a lower PE relative to the growth rate. So I wanted to explain PEG ratios across the US. And one of the variables that affects the PEG ratio is the level of the growth rate. So I started by running a scatter plot of the PEG ratio against the growth rate. Now I try to fit a line, but you can already see that I'm really stretching it. This looks like there's a curve through this. It's a nonlinear relationship. Now I know I could run a nonlinear regression, but nonlinear regressions are difficult to read. They can be messy. So I tried something much more low-tech. What's causing this nonlinearity is that my growth rates go from 0 to 100%. The range in my growth rates is much wider than the range in my PEG ratios. Now, one way in which you can reduce the range in your growth rate, make the numbers closer together, is I can take the natural log of the growth rate. The natural log is a number you can compute, you can look it up, or you can use your calculator, your computer. I took the natural log of the growth rate, then I reran the scatter plot. It's not perfect, but it does look a lot more linear, right? When you see my regression for PEG ratios, guess what you're going to see? You're going to see the payout ratio in beta, just like you did with PE ratios, but instead of putting in the growth rate, I've used the log of the growth rate. The bad news is the R squared is much lower than it was with PE ratios. Again, am I disappointed? Well, it is what it is. The data, that's the best I can explain of PEG ratios. The good news, though, is all of the t-statistics are now significant. T-statistics, p-values all suggest significance. But again, to decide to use log growth, it was trial and error, running a scatter plot, rerunning a scatter plot. Be ready to do that with each independent variable. The third point I want to talk about is sample sizes. Holding all else constant, would I like a larger sample rather than a small? Absolutely, I'd like a sample of 100, a sample of 1,000. But sometimes beggars can't be choosers. When you start to put together a sample to run a regression on, perhaps the best you can do is 15, 20, 25 observations. You can't get blood out of a stone. If you tried to run a multiple regression with 15 observations but 5 independent variables, you may get a regression that looks good on the face, now high R squared, but it's absolutely useless in predicting and explaining dependent variables. I'll give you an example of it in a minute. But you have to be careful not to let your ambitions run ahead of your sample size. So here's a simple rule of thumb. And it's a rule of thumb that works for me. You might develop your own rule of thumb. If your sample size is 10, 15, even 20 observations, stick with a simple regression. For every 10 or 15 additional observations, you get the freedom to add one more independent variable. So if you have 35 observations, you can go to 2 variables. 50, you can go to 3. Because when you take a small sample and force through multiple variables, here's what your regression is going to look like. This was a regression run on a sample size of 9. And the person running the regression threw in 4 independent variables. Now, at face of it, you're saying, this is good. Look at my R squared, 75. That's completely deceptive. This regression is almost all noise. You're saying, you're overdoing it. Not really. Look at the t-statistics. None of these independent variables are statistically significant. The only reason your R squared looks good is because you're overwhelming the data with this multiple regression. This is a useless regression. With 9 observations, the best you could possibly do. And even with a simple regression, you're probably pushing it, is using 1 independent variable. Which brings me to my final point in regressions. I mentioned dummy variables in an earlier session, but a dummy variable takes on the value of 0 or 1. Let me give you a very simple example of how a dummy variable might come in handy. This was from an analysis I did a long time ago in the late 90s. I was looking at telecom companies globally that had ADRs listed in the US. So these are foreign telecom companies listed in the US. And the advantage of having these ADRs is the earnings are measured using US accounting standards. So these PE ratios should be comparable. Now, the general rule in PE ratios is lower PE ratios suggest cheapness. So if you look based on PE ratios, Indosat, which is the Indonesian telecom company, and Telebras, which is the Brazilian telecom company, look a lot cheaper than other telecom companies. Now, before you get too excited and put your money in those two, there are two things that should worry you about Indosat and Telebrás. One is they have much lower growth than the growth rates of other companies. So lower growth companies should have lower PE ratios. And here's the second. In the late 90s, emerging market companies were viewed as massively more risky than developed market companies. So if you look at the sample, there are some emerging market companies, but New Zealand and France are developed market telecoms, and they're in the sample too. So I'm worried about low growth, and I'm worried about the fact that some of these companies are riskier because they're emerging market companies. The growth I can bring in with the growth rate is saying, what do I do about the fact that some of my companies are emerging market companies and some are developed market companies? I'll tell you what I did. I used a dummy variable. I called it my emerging market dummy. I set it to 1 if you're an emerging market company and 0 if you're a developed market company. And I ran my regression of price earnings ratios against growth rates and that emerging market dummy. You see what I'm trying to do? I'm trying to control for differences in growth and differences in risk. Here's what my output looks like. Let's look at what the coefficients, what the output tells us about the regression. First, the R squared is 66%. The sample size is small. I'm not going to get too excited, but that's a pretty reasonable R squared. I can live with that. The constant is 13.115. What does that mean? That's a base from which I'm going to get the PE ratio for every telecom company. It tells me something about the entire sector. Every 1% increase in growth rate increases my PE ratio by 1.21. I've now captured the effect of higher growth in PE explicitly. So if your growth rate is 5% higher than mine, your PE ratio should be roughly 6, 5 times 1.21 higher than mine. The T statistic is significant. The p-value backs it up. But let's look at the emerging market dummy. Remember, this was a number that I set to 1 for all the emerging market companies and 0 for the developed market companies. The coefficient is minus 13.85. What does that mean? If I have two companies with the same growth rate in 1997, and one is a US or a European telecom company, the other is an emerging market telecom company, based on how the markets were pricing these companies, the emerging market company will have a PE ratio 13.85 lower. The T statistic on that is also significant. The regression passes at least the minimalist test. You say, what point is there to running this regression? Remember Indosat, the Indonesian telecom company, looked cheap because it was trading at 7.8 times earnings. If you go back 2 pages, that was the lowest number. If I plug in the growth rate for Indosat, which is 6%, the fact that it's an emerging market company, into my predicted value, I get a predicted PE ratio for Indosat of 6.55. Based on its low growth and its high risk, this regression is telling me Indosat should trade at 6.55 times earnings. At 7.8 times earnings, Indosat is not cheap, it's expensive. Again, this is not some magic bullet, just a way of bringing in your concerns rather than hand waving and saying the one hand on the other hand, because where you're going to end up. So as you look at regressions, be creative, but don't overreach. Don't make having a higher R squared the end game. Ultimately, if you're going to use these regressions for predictions, you got to make sure that you are in fact checking for statistical significance, and more importantly, if you want to make money on it, for economic significance. I hope you found this session useful, and thank you very much for listening.